When you get greedy, that's when we get in trouble, right? Take your wins, take your gains, get back in balance. So what we're going to find is 4 main principles for the basics of investing that I want to share with you today. Point number 1, these are fill in the blanks for you. Point number 1 is you need to determine your investor profile. So write that down, determine your investor profile. Who are you as an investor? How long will you live in retirement? What's your risk tolerance? That's the big one. Can you sleep at night if you lose half your money? The C Fund lost 47% in a 12-month period back in 2008. Some of you are like, yeah, but it made it all back. I'm ahead of the game. Okay, that's a risk tolerance. Some of you are like, I don't want to lose half my money. Right? So be true to yourself, because the number one detriment in investing is lying to yourself when things are good and then getting real after you've lost a bunch of money. Let's be real on the front side with who we are. How long do you have to use this investment? What's your liquidity needs? How much money you're going to need? If you need to touch this money in the next short period of time, let's say 5 years for this discussion, then in 2008 happens again. It took more than 5 years to get your money back. So you can't put at great risk, the money you're going to need in the short term because you could stand a chance of losing substantial dollars in that world. So you have to be careful with that. But you can just write down a couple of ideas of your investor profile as it relates to tolerance or capacity, and I think that will help you. Also, there are many different websites out there where you can take a risk tolerance questionnaire and get through that information by yourself. There is one at retireinstitute.com as well. And it's kind of like a mirror. If you take one of those tests, you might say, well, I could take a lot of risk, but I really don't like losing, and you talk out of both sides of your mouth. You do a test like that, and it makes yourself look at the mirror and go, okay, this is who I am as an investor. So that, I don't want to underestimate. That's very important that you know that going into it on the front side of investing as opposed to on the back side when you realize you weren't lined up correctly. Second, we want to allocate appropriately. So in your TSP, you have these different lettered funds, and to allocate appropriately simply means put the money where it should be based on who you are as an investor. I'm going to simplify that for the case at hand and say, let's say you are a good fence straddler and you're 50-50 at the end of the day, like most people are. What would you do? Oversimplify. Maybe you put half the money in the C fund, half the money in the G fund. Okay, because that's the amount of risk you can take. I don't want to lose 47%, but I could lose 20-something% in order to try to average that 13% 10-year return maybe, if that's what you could hope to get. And so you would allocate the money between the funds at a given point in time. But then what's going to happen the next day, the market is going to change the value of those accounts, isn't it? And so it only held for a day. Now you're different. Now you're allocated differently. So we have to then come back, point number 3, we have to reallocate tactically. So reallocating tactically simply means, let's say the C fund has a good run in my example, and all of a sudden now 60% of your money is C fund, 40 is G. Now you're weighted heavier than your risk tolerance says you should be, correct? What should you do? Sell the thing that's at 60, buy the thing that's at 40, get yourself back in balance. You know what the problem is for us with that? We're selling the thing that just went up. I mean, if it went up, isn't it going to keep going up? And I'll share with you great wisdom of being in Georgia where there's a lot of farming going on, right? Pig farming, pigs get fat. Anybody know the rest of that saying? Hogs go to slaughter. Right? When you get greedy, that's when we get in trouble. Right? Take your wins, take your gains, get back in balance. Because when the market goes down, it's again in that same example, flip it the other way. C fund goes down, G fund's now a higher percentage of your holdings. What are you going to do? You're going to buy some of that stuff that's low in the market. You're going to rebalance again. Now you're buying low. So that rebalancing effect works to the good on both sides of the equation. So I encourage you to reallocate. How often do you reallocate? There's a lot of different articles out there on the internet about how often, if you should do it quarterly. The L fund does it quarterly or semi-annually or annually. You can't do it too often. How many trades can you have in your TSP right now? 2 a month, right? So you can't do it weekly, which would drive you crazy. Hopefully you have too much to do than to reallocate that thing weekly. That'd be a lot of work, right? But you only get those handful of trades that you can do. So, and then my last point is built around this comment. If you look in the second bullet point, it says that investors are often motivated by, what are those two words? Fear and greed. And so I take you to the nightly news that maybe some of you watch. And they put a talking head on there, and he says, the market is going to collapse. It's going to be awful. Things are falling apart. But I'm going to tell you where you cannot lose your shirt in this experience after these commercial messages. Right? And he comes back, same television station, 2 hours later, another guy gets on there and says, oh, the market's fixing to take off in certain areas. It's going to really grow rapidly. And if you will just follow my rules of how to make a lot of money, I'll help you right after these commercial messages. Right? What are they selling? Commercials. How do they make a profit? By getting you through the commercials. I'm not saying that television is there to do you wrong. I'm not saying their advice is good or bad. I'm telling you the motivation is clear that they are in a for-profit environment and their profits are had by the commercials. Fear and greed will lead us down a path of danger that will lead us right through the commercial breaks and make those companies their profits. So be careful. Filter that stuff out, the things that create that fear and that greed, and you recognize them for what they are and set them aside. Which leads us to our fourth point, which is do not go with the flow. Do not go with the flow. You will see on this graph at the 10-year period, the green line represents the S&P 500, and you actually can see the point in 2008. See the big dip on the graph in 2008 where things went down. The blue and the yellow lines represent inflows and outflows into the market. So one of the rare times when we Americans were taking money out of the economy the market was in 2008 at the very bottom. Remember how you felt 10 years ago, those that were investing at the time? This thing's going to zero. I'm going to lose it all. I need to take something while I can. Were a lot of things that were said. And what was Warren Buffett saying? Now's the time to buy American. Boy, it wasn't a great investment time. But if you're all in and then you come out, you just lost your opportunity to regain some of that 40+% decline. So don't go with the flow. Don't let that greed and that fear keep you from making a good long-term strategy and sticking with it. The most dangerous thing you can do is to have a strategy, things get rough or things get really good, either way, and you begin to just change that strategy out of fear or greed, and then to recoup those losses is very hard, very, very difficult.